The beginning of an enduring deflationary recession in response to the excesses of excess that peaked in 2021. Cryptos are a good part of that. They went up the most, they've gone down the most, and they're probably going to stabilize. So I think some of the best performing assets will be long bonds, gold, and Bitcoin. I think the stock market's going to have a pretty significant correction akin to 1930s. And it's a simple peak. How about in 2000, it took 13 years to take out that high? Well, we should have similar.
A rising U.S. dollar is causing increasingly more concerns for market experts. The U.S. dollar index, which tracks the dollar's strength against a basket of major currencies, shows that the world's reserve currency is rapidly gaining value against global currencies. Last week, we saw the British pound fall to an all-time low against the dollar. This largely unprecedented rally is also of great concern in China, where banks are reportedly gearing up for a massive dollar dumping campaign to strengthen the yuan. According to reports, the People's Bank of China has told major state-run banks to prepare to reduce their dollar holdings and buy more offshore yuan. The latest round of interventions to save the yuan will be massive and will mainly involve the state bank's currency reserves. Their offshore branches have also been ordered to review offshore yuan holdings and check to see that dollar reserves are ready for the big dump. This comes after the yuan fell to 7.13 against the dollar on Thursday. It is currently on track for its worst annual decline in 28 years. This year alone, the yuan has declined by over 11% against the dollar. The dollar's upside rally is also causing some concerns back home as asset prices have continued to plunge lower. On Friday, the S&P 500 hit a 52-week low 3,584, a new 2022 low and its worst monthly close since March 2020. The Dow Jones Industrial Average closed below 29,000 for the first time since November 2020, falling by 500 points to 28,725.51. The Nasdaq Composite also fell by 1.51% to 10,575.62. In a recent interview, Bloomberg's senior commodity strategist Mike McGlone discusses the current state of the markets and the dollar's role in it all. Please watch, share, and like this video as McGlone describes what he calls the Great Reversion. Also, ensure you drop your comments and observations in the comments section, subscribe to the channel, and turn on post notifications for more videos like this. Thanks and enjoy the video.
The thing I like to mention about the DXY, you just inspired me to do this, it's relative movements that matter the most. And right now, the DXY relative to its 100-week moving average is 18% above that. It's only happened once in history at the peak in 2015, right before the collapse. So it's pretty well extended. 100 weeks is pretty standard. It's almost 2 years. It's 2 years. But that's the relative strength of it. The thing is, DXY is measured virtually against the Europe. We all know Europe's basically a basket case. I mean, they don't have, I shouldn't say a basket case, but there's so many independent countries. I mean, I live there. We all know why most of us Americans have emigrated from there because of the wars and forever. But comparing to another, bigger baskets, like we have a Bloomberg index and the trade-weighted broad dollar, I see it's not nearly as much as it rallied as much into the peak in 1985. I remember that well. I was in France as a student. But this is what's breaking, and this is part of what the Fed ignores. And the number one way to make this stop happen is the U.S. stock market going down relative to the rest of the world. Yes, there's other things in the big picture, but that's been one of the key drivers over time, is the U.S. stock market outperforming the rest of the world. Now, yes, it might be a little bit lagging when people start taking their money out of U.S. assets, but where are they going to go? Honestly, okay, in the short term, even the bond market, it's the lesson I learned trading treasuries years ago. There's no bond market in the world that's even close to the U.S. Depth, security, volatility, getting 4% on a 2-year note right now. Thank you very much. I mean, what person in the world is not going to do that? So people only sell treasuries because they say, oh, they have to. And so I look at it as this is part of breaking right now in this rest of the world. This is part of, to me, is going to be the Great Recession. It's kicking in this year. I'm calling 2022 the Great Reversion. And I view this as very similar to 1929. Yes, that's a good point, and it's a good point to say it's less likely to see a crash in U.S. equities, but typically dollar flows will flow to fixed income T-bills,
Mm.
and 2-year notes. Not really long bonds, but when you can get literally 4.3%, I pointed this out a few months ago, is the highest rates in the world, the deepest bond market, and most likely that inflation is going to collapse is in the U.S.
Mm.
And the Fed's there for you. I mean, you're not going to go to the British pound right now. You look what happens there. So maybe you will because of relative value, but that's the key thing. But why are equity markets declining? Why is the dollar? Part of the reason the dollar is reacting is because we have just gone through the biggest pump in liquidity, money supply ever. Got like 26% ever. I mean, I go back to 1960, and now we're in the middle of the biggest dump. We're taking liquidity at the greatest pace ever. Now I'm only 60, which means risk assets have to go down. So it's that, that sugar high that every single time the market went down 20%, the Fed would ease, is going away. So people get that. There's sellers up above in the equity markets. The mature long-term rational money managers understood this punch bowl is being taken away, and the party lasted for 40 years, so it's going to last a while, and it's very likely to head towards recession. But if you look at it this way, I look at it, if I'm an international investor, maybe some combination of U.S. equities, but I think long bonds are going to be some of the best performers. I've been wrong, but typically once this triggers, once we get that little flip, it's going to happen so fast. I expect rates to drop double the velocity, or maybe quicker the velocity than they went up, and then we have this enduring deflationary recession kicking in. But this is the difference now. The world has changed. The Fed will not be there to save you once we get death threats, and they will get death threats. Paul Volcker got them.
In his interview, McGlone gives his outlook for the markets as we edge closer to a severe global recession. The senior commodity strategist states that cryptocurrencies remain great choices for investors who are willing and able to take advantage of the bear market. McGlone explains that there might be more pain ahead for investors as the Federal Reserve struggles to counteract the monetary policies of the past 2 years. But assets like crypto, bonds, and gold will make great investment choices. Here's another clip from McGlone's interview.
The beginning of an enduring deflationary recession in response to the excesses of excess that peaked in 2021. Cryptos are a good part of that. They went up the most, they've gone down the most, and they're probably going to stabilize. So I think some of the best performing assets will be long bonds, gold, and Bitcoin. I think the stock market's going to have a pretty significant correction akin to 1930s. And it's a simple peak. How about in 2000? It took 13 years to take out that high. Well, we should have had similar extremes. What we've never had is the foundation. I mean, foundation for virtually all dumps in history is going up too high on the back of easy money. We've just never had money this easy ever. Now, I'm not blaming anybody for that. Remember, it was only about a year ago we got vaccines, and there was a lot of fear out there. So yeah, the Fed had to make the risk of pumping up all the liquidity, but we didn't get that. We had a blip of a recession. Now we're going to get a significant recession globally. And I fully expect there's going to be a lot of good to come out of this. In the meantime, we've got to have a lot more pain to reduce inflation. We'll get that. I think inflation is going to drop at extremely high velocity. People don't realize that yet. Like the base effect in crude oil, going from 50 to 130 is pretty significant. Going back down to 50 is what it's going to do. So I fully expect things like crude oil to do what they always have been. It's one of the most significant mean reverting commodities on the planet. Crude oil goes up a lot, goes down a lot, but it never, I mean, the price right now, $77, which might be different when this airs, is the same price as 2007. Imagine if we said that about the stock market, 15 years unchanged. That's called deflationary forces. So I think what Jeff Booth pointed out in his book, The Price of Tomorrow, of all kicking in, hopefully we won't have a nuclear risk out of Russia, Ukraine. If that happens, it tilts the world to a more extreme recession. It boosts prices like grains and T-bills, and who knows how bad that can get. But to me, that's my base case, and I don't see anything to stop it at this point. Now, the key thing is when I mentioned this September, when I mentioned this 9 months ago, people use the idiot factor on me. Now it's less the idiot factor, and it's just pointing out facts of history. So I think gold's going to come out of this head. Typical commodities do what they always do. They mean revert, and they get cheap. So I think what's going to happen is risk assets are going to have to get real cheap. Housing should collapse. I mean, look what interest rates have done. And it's just a matter of time that all the lagging indicators follow that. I mean, inflation is very much lagging. I think everything is basically going to follow copper. It's down 24% in the year for a reason. Crude oil, probably end up down 24%. And this is just what happened in 2008. But remember, that was just U.S.-centric. This is global. China is collapsing. And when we pointed this out years ago, why do they steal intellectual property? We know how to answer that question. But the housing market there is horrible. And they have no good fixes. Their stimulation is beyond. Remember, look, and their currency is starting to plunge too. Europe is collapsing. What gets Europe out of this? Maybe some kind of enduring peace, but Putin has to leave. Gone. Completely gone. But for that to, people can't trust him. And so I view this as 1929, 30s kicking in, and the Fed the most reluctant in history to provide liquidity, partly because they learned the lesson of too much liquidity.
In a recent tweet, renowned Rich Dad, Poor Dad author Robert Kiyosaki shared similar sentiments about the dollar's impact on asset prices. His tweet reads, "Buying opportunity. If the Fed continues raising interest rates, the US dollar will get stronger, causing gold, silver, and Bitcoin prices to go lower. Buy more. When the Fed pivots and drops interest rates, as England just did, you will smile while others cry." What do you think about McGlone's interview and Kiyosaki's tweet? Are you buying more Bitcoin or waiting for prices to go lower or higher? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more crypto-related videos. Thanks for watching.